Ladies and gentlemen, good day and welcome to the Sterling Tools Limited Q3 FY23 earnings conference call. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and then 0 on your touchtone phone. Please note that this conference is being recorded. We have with us today Mr. Atul Agarwal, Whole-Time Director, Mr. Jaideep Wadhwa, Director, Mr. Pankaj Gupta, Chief Financial Officer. I now hand the conference over to Mr. Pankaj Gupta, CFO of Sterling Tools Limited. Thank you, and over to you, sir.
Good morning, everyone. On behalf of Sterling Tools Limited, I extend a warm welcome to our Quarter 3, 9 months FY23 earnings call. I'm joined on this call by Mr. Atul Agarwal, our Whole-Time Director, Mr. Jaideep Wadhwa, our Director, and SGA, our Investor Relations Advisors. We have uploaded our results presentation on the exchanges, and I hope everyone has had a chance to go through the same. I will now request Mr. Atul Agarwal for his opening remarks.
Good morning, everybody. Welcome to the call this morning. This is I think third in the series of the calls we've been doing with you. Once again, very warm welcome to Sterling Tools, and we hope to see you guys more in physical meetings as we go forward. Well, we've had a good quarter and a good 9 months, and broadly what I can say is I think we are fourth quarter is also looking quite optimistic. We have a good momentum in our business, and we believe we are on a path in operation side and product lines going forward. Just to give you a sense, Sterling Tools has four facilities, 3 in NCR area, 1 in Bangalore. That business is doing very well. As the numbers say, Pankaj will run through the financials with you. But I want to talk, but I think we are up about 33% in revenue. So despite the challenges in production levels with our customers, I think we've been able to grow faster than the industry in that segment. But I want to spend more time on our electronics business, on our motor control unit business, which has done extremely well. We had closed last financial year. Since we started operations, only in the last quarter, last financial year, we did about 40-odd crore in that business. I think we're looking at a 4x growth in that business for this year. So we are closing that business at about 120 crores for about 9 months this year. And the most important fact would be that in the first full year of operations, we already have a positive bottom line. The business is already generating cash in the first full year in the business. We manufacture motor control units for electric vehicles, and we believe we have a 50% market share in the two-wheeler high-speed scooter segment. We have done a tremendous job in that. We have the first mover advantage in that business. Our businesses are reasonably localized. Our supply chain is localized, and more importantly, we have a large tech center abilities with 2 tech centers out of Faridabad and Bangalore. So the kind of customization and product optimization we are able to do, we believe we are reasonably ahead of our competition. And so the visibility for growth in this business is very good. Also, we will also be. I'm just going to give you broad statements out here. We'll also be adding more components in the electric vehicle supply chain. We are currently studying. Jaideep is there on the call. If you have any specific questions, he'll be more than happy to take them on for you. But broadly, I just want to mention that we've had a good 9 months, and we're looking at closing at a good financial year itself also. And hopefully, we will continue this momentum in the years going forward. I'm going to hand over the call to Pankaj to run through some financial numbers in detail with you, and then we'll open the room for questions where Jaideep, I, and Pankaj will be happy to take on anything you want to have answers for that. Pankaj, over to you.
Thank you, sir. So once again, welcome. The financial highlights for this quarter and for the 9 months. An excellent 9 months run for Sterling, and when I speak about financial standalone as well as consolidated, our revenue grew by about 30%, and we had 151 crores of revenue in this quarter. I'm talking of standalone. And the revenue has similarly increased by 33% to 445 crores in 9 months in the current financial year. So that's 33% growth in the fastener business. And the increase in volume and our capacity utilization and focus on from beginning of the year to reach to 575 to 600 crore of turnover, we are aligned to that. So a good revenue run for 9 months. EBITDA margins in this period, we had 17 crore of EBITDA roughly, which was the last year, and we had 23 crore of EBITDA margins. In terms of percentages, EBITDA margin is 15.4%. Cumulative EBITDA margin for the 9 months is 71 crores, which is again about 32% higher than the previous year. Profit after tax, we had a growth of 52%, 10 crore of PAT in quarter 3, and we reported PAT of 36 crore in this current year. The consolidated financials, the revenue increase is about 70%. We have revenue of 208 crores in quarter 3, and total revenue of 560 crores in 9 months. And the revenue increase is a factor of increase in our MCU sale in this year, and also sale in the fastener business. So 560 is the number. EBITDA again has seen an upswing from 16.8 crores to 28 crores in quarter 3, and cumulative EBITDA of 9 months stood at 77 crores. Again, in terms of increase, 52% increase over last year. Profit after tax has grown by almost 150% to 13 crores during quarter 3, and we reported a PAT of 40 crores for 9 months. The EV vertical, our revenue in 9 months is 119 crores. If we go to the comparable period last year, was only 7 crores, because that was probably the first quarter where we started clocking the revenue. The full year revenue, just to have a data point, was 38 crores last year. So 119 in 9 months against 38 crores the full year. EV business, a very exciting part, which Aturi also mentioned. In the very first full year of operation, we have a positive PBT in electric vehicle MCU business. So very exciting time. Thank you very much, and we can open the floor for the question and answer now.
Thank you. We will now begin the question and answer session. Participants who wish to ask a question may press star and 1 on your touchtone telephone. Participants who wish to ask a question may press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have the first question on the line of Nidhi Babaria from Invision Capital. Please go ahead.
Thank you, sir, for taking my question. Sir, if you can help me understand what are the gross margins and operating margins in MCU division for 9 months and Q3?
Yeah, so MCU business, we are currently at a EBITDA margin of about 6%. And that is what 9 months average margin is. This includes this is a new business, and we keep a lot of provision for warranties, etc. So and this is a business, as we say, we are adding a lot of customers, a lot of development work is going on. So currently this is the one, and we shared our advisory will be about double-digit margin is the target what we have for MCU business.
Jaideep, you want to add to that?
No, I think, sorry, I would just say that early stage of the business. We are investing tremendously in the engineering capabilities, etc. And like Pankaj said, we should go from the mid single digits that we have right now to the low double digits in the coming period.
Okay, and what would be the gross margins for the same? Because if I see the consolidated gross margins have impacted hugely on a YOY basis, even on Q-on-Q basis. So just trying to understand what all could be the reasons for that.
Jaideep, let me take that.
Okay.
I think we got to separate the two businesses. When we talk about margin structures, we got to separate the two businesses to get a better understanding of consolidation. Sterling is currently operating at about 16% EBITDA operating margins. And Sterling GTech, the MCU business, is currently at about 6% levels, which we think the 6% levels should normalize this year to maybe 7%, 8%, and maybe in the very near term, we are looking at anywhere in the range of 8 to 12% EBITDA margins. Our fastener business historically has been ranging between 16 and 19%. We are on the lower side because there were a lot of commodity price increases, and we've been able to get compensation and inflationary pressures, which we've already done a lot of mitigation exercise through price increases and cost cutting internally. So if you see our EBITDA margins last year was around 15% in our fastener business, it's gone up to 16. We believe we have a lot of momentum on the positive side. This number will only improve as we go forward. And having said that, additionally, another factor which impacts the percentages are the mathematical equation. Our raw materials have gone up by almost 40% in the last 2 years. Since our steel as a percentage of our selling prices is sub 40%, our price increases have been in the range of 12, 13% only. So when you do a numerator denominator effect, it has an impact of additional 1.5%. So like to like comparison from a selling price basis and a buying price basis, I think we are doing fine. You will see if you do those numbers, we'll be fine. So if you look at the two businesses independently, both have a different DNA. One, we are doing a traditional automotive component for the last 30, 40 years, and despite that, we still generate 16, 17% EBITDA levels on that, which I believe is very healthy, keeping in mind the peer group in the industry. On the most MCU side, it's like Jaideep said, it's a new business. Supply chains are very new. Customer learning is also new. We are investing on top of that. We are investing a lot of money in our engineering capabilities. There's a lot of tech center competencies we have added to that in people, etc., etc. Currently, we are at 6%. We'll probably go to 8 to 12% in times to come. But if you consolidate the two, obviously, the weighted average margins kick in. But I think you got to assess both independently. When I say that, what you also got to keep in mind, the return on capital employed in our MCU business is substantially high. We are looking at north of 30%, maybe at times up to 40% levels, which are in our fastener business are about 20-odd%. So both are different DNAs, different animals altogether, and I think they need to be assessed in separation. But yes, on a consolidated basis, I think we are at about 13-14% level right now.
Yeah,
14% levels. That should only get better, which as we go forward, close to 15%. But yes, just to give you a sense of the numbers independently for both the businesses.
Okay. Still, sir, if you can give me some color or some very rough numbers on gross margins for MCU business, because I understand that is surely dragging our overall EBITDA margins. But like, are these gross margins going to sustain, or can we see more impact going ahead as and how the MCU business increases from here?
So normally what we analyze across, as I said, 40% approximately is the material cost. We have about another 25%.
What you want to know about the MCU business?
MCU business, again, it's a very, as we say, it's a working capital intensive business with a very low capex. and material cost.
I think Pankaj, the question is on the GM. So let me just say this way.
Sorry.
Jaideep, take that, please.
Yeah. Okay. So, to answer your question, our gross margins will be in the 20s in the MCU business. As supply chain issues ease out, we hope to be able to improve that.
Probably go to close to about 24% over time to come, yeah.
Yeah. So, and not maybe even, I can't give you exact prediction because right now, the supply chain, the electronic supply chain is so difficult to predict. But, it could be better than that. But we're in the 20s, as the situation eases out, as we stabilize on long-term contracts with some of our suppliers, we hope to be able to improve that further.
Okay. And sir, on other expense side, our other expense as percentage to sales has gone down significantly from 34% last quarter to 27%. And even on absolute basis, we have reduced our other expense. If you can help me understand which line item has moved or what exactly the other expense is looking right now.
You're talking of Concall or standalone, ma'am?
Concall. Last quarter, we had some 61 crores of other expense. Right now, we are at 56 crore. And as percentage to sales, surely our top line growth has been significantly higher. But do we expect that this other expense is going to sustain or any changes in any of the line items?
So we took a note of this point. We'll come back to you on this because other expenses is largely fixed cost, and as a turnover increases, this probably the percentage will come down. We'll come back to you on this with more analysis.
Okay, sir. I'll just come back and see.
Thank you. We have the next question from the line of Tushar Sarda from Athena Investment. Please go ahead.
Yeah, thank you for the opportunity. I wanted a little more color on the MCU business. How big is the opportunity size? What is your supply per vehicle? And what is your market share? If you can, because it's new, just from understanding point of view, if you can explain on this.
Atul, would you like to take that? Do you want me to address that?
You can take that. You can take that, Jaideep.
Okay. So, first of all, I think the size of the opportunity is huge. I'll give you, but I can't give you an exact number because every report that we read gives us a slightly different and usually higher output. There was a higher number. There was a report recently that said that by 2030 we could have more than 30% penetration in the two-wheeler segment for electrification. 30% electric, and if you assume that business is close to 30 million units, you're talking about 10 million units being electrified. And that, even taking a weighted average between high-speed scooters, low-speed scooters, you're talking about 8,000 rupees in MCU. So, you're talking about a very significant market, and I'm just talking about the instance. And then, of course, there's the three-wheeler market where you could see 70-80% the penetration, and the LCV market, again, has a similar projection. So the market itself is absolutely...
Jaideep, we are losing you in the middle. Are you in a... Yes. Jaideep, we are losing you in the middle.
Mr. Wadhwa, are you able to hear us?
Jaideep, we are losing you.
Sorry, can you hear me now?
Yeah, I think, yeah. Are you moving some? We are losing you. You're going in and out.
I'm not moving, but I'll just be a little bit more careful. Sorry. I don't know where I got off or where I dropped off from. Could you...
30% penetration.
Yeah, so talking about 30% penetration would mean 10 million vehicles, and even at 8,000, at a weighted average of say 8,000 rupees per MCU, that's a very significant market. In the LCV and three-wheeler spaces, you could see upward of 70-80% penetration, because these are very, very appropriate for electrification. So the market itself is very, very large. The second question was, what do we, what's our pack price for MCUs? It ranges, from at the bottom end of about 3,500 rupees from the absolute low cost scooter, where we don't do very much, but we do have a product, to about 12,000 rupees for a three-wheeler. The average sits somewhere around, our weighted average sits somewhere around 10,000. So it's not, it's a significant amount of the total vehicle price. In terms of our market share, we have close to 50% market share in the high-speed scooter market, and we have about 30% market share in the overall electric scooter market. So very healthy market shares there. The three-wheeler market, I'm not able to give you an exact number, but because there are a lot of moving pieces there in terms of the way the e-rickshaws numbers are reported. But again, I would estimate that we would be in the 20s or 20 to 30% kind of number.
If I can add on top of that, just to give you a flavor of the potential size, depending on the penetration. Assuming the current size of the two-wheeler market is at 15 million, and currently that's the biggest segment for electrification right now, plus public transport buses, and then you got passenger vehicles coming in, commercial vehicles kicking in. But let's just talk about the two-wheeler market at a 15 million level currently. Let's look at a very wild scenario where all 15 million become electric, and an 8,000 rupee unit price on an average. You're looking at roughly, I think, about 12,000 crore revenue, 12,000 crore market size for this product line itself. I'm not saying we'll maintain 50% market share. Obviously, the market shares will fall for us eventually, but one can do, back of the envelope calculations, even at a 10-20% market share, what that means for our business going forward. So, looking at a revenue, each of us can do our own homework on it, but we have some very optimistic numbers for our business going forward, keeping in mind the total addressable market. And this idea was just to give you a flavor as to where we are.
No, thank you. Thank you for a very detailed answer. I had two follow-ups on that. One, who is your competition?
Sharda would request you to kindly come in the queue for follow-up questions.
Okay. Thank you.
Participants are requested to kindly restrict your questions to 3 per participant. Participants are requested to kindly restrict your questions to 3 per participant. We have the next question from the line of Dipan Shankar from Trustline PMS. Please go ahead.
Good morning, everyone, and thanks a lot for the opportunity, and congratulations for good set of numbers. So firstly, on the two-wheeler MCU side, so are we started supplying MCUs for our second and third customer, and how has been the ramp up there?
So our business awards and supplies are we are now currently at 14 customers who are in production with us at different stages. The ramp up is been slightly slower than we would have liked because of the change in battery regulations that the government pushed forward. So a lot of the companies had to rework their BMS and battery strategies and technologies, which has caused delays. And as you're probably aware, the waiting period to get a certification done for a battery pack today is months right now. So because everyone who is not in production has to get recertified on this. So or get certified as per the new standard. So the ramp up has not been as we would expect, but we have been engineered into the design of several vehicles, and and supplies have started. They are in the thousands right now. They're not in the tens of thousands, but we hope to get to the tens of thousands within. I mean, in some of them even within the next couple of months, next few months. I won't say couple, but next few months.
Okay, okay. And any updates on the production supply for our electric three-wheeler, motorcycle, and LCV customers? And when do we expect the full ramp up happening there?
So three-wheelers, like I mentioned, we are doing, I'm going to just, sorry, I'm just going to do a couple of counts as we speak. So on three-wheelers, there are at least 3 or 4 different platforms which are selling in numbers. Some of the exact three-wheeler data, like I said, it's difficult for us to. Sorry, just. So the three-wheeler data is exact. Market share is a little difficult for us to estimate because of the fact that we get confused with or we get confusing numbers along with the e-rickshaw market. We are also in production with a couple of LCVs and even with farm equipment. So across the board, we've got representation in across all the categories: two-wheelers, motorcycles, three-wheelers, LCVs, and farm equipment.
Okay, okay, sir. And lastly, from my side, so at the current EV run rate, so we'll be almost fully utilizing this 3 lakh capacity. So when will be our next expansion, this 5 lakh capacity getting commissioned, and any plan for further expansion?
So the construction is getting kicked off within the month of February. Equipment has already been ordered, and some of it has been shipped. And in terms of, and we are actively evaluating if we need a second facility or not. I can't give you an answer on that right now, but we are actually having those internal discussions at this stage.
So the 5 lakh capacity, when it will get commissioned, sir, fully?
We would want, so we will be, I'm just going to try and give you, I think by, in the second quarter of, in the first quarter of the next fiscal or the second quarter of this calendar.
So we'll be ready by June, July this year.
Yeah, June, July this year we'll be fully ramped up, but we will have, we'll have some increases coming up even before that because we are making some, we're debottlenecking certain operations to maximize the output from the current facility.
Yeah, so I think in net June, July we'll be ready with that 5 lakh capacity.
Okay, okay. Thanks a lot and all the best. I'll come back in the queue.
Thank you. We have the next question on the line of Nikhil from Simple. Please go ahead. Nikhil, can you hear us?
Hello, can you hear me?
Yes, we can hear you now. Please go ahead.
Yeah, I have just 2 questions. One is on the fasteners business. Sir, you mentioned during the discussion that the gross margin was impacted because of the RM cost being higher. Now, if we look at it, that is true on a YOY basis. But if we look at on a QOQ basis, last quarter our gross margin was around 60%, and this quarter it came to 57%. So, is there a product mix difference which also impacts, or what has happened that on a QOQ basis the margins have dropped?
So, I think these are, I will not worry about quarter to quarter numbers, primarily being that we carry a large amount of inventory. So it's just an accounting issue where if you had a lot of steel you're carrying in your system or work in progress which is bought at the higher peak levels of steel, then you carry that for a quarter till it's liquidated. So it's more of an accounting issue. When I would assess this, I would look at it on a minimum half yearly, if not an annual basis. Quarter to quarter will not give you the right picture. And that's what we like to do in our business when we run this analysis. So we're not really worried on that. Because our inventory cycles...
Because the steel prices had corrected, so we were expecting that in this quarter our gross margin should sustain. So
that's what I'm saying. So you will find it all balancing out by 31st of March. All numbers will be annualized, and we get a sense of what the annual numbers look like. So which are healthier than what we had last year.
Okay. And secondly, you mentioned that on the motor control unit business, we are carrying some warranties of warranty provisions, and also, is it a large number in terms of these warranty provisions, or and what kind of warranties or what kind of a product issues can come up?
So let me address the financial part for you first, which is, yes, we have warranties out, and what numbers what we're showing you, 6%, are post those provisions. We are providing certain percentages for warranty, for potential warranty costs proactively on a month-on-month and a quarter-on-quarter and year-on-year basis. So what you see of operating margins are post those provisions. So we are following a conservative accounting policy and conservative operating posture on this whole thing. I think we have given 3-year warranties to our customers for our product lines, and from the data what we have till now for the year, for about 12 months operations, those warranty numbers do not seem to concern us at all. They're minimal against the provisions we have already taken in our P&L. So we are on top of that, and it's those numbers are more the provisions are more conservative, keeping in our philosophy of giving conservative outlooks to our customers and our investors.
Okay, fine. Thanks. I'll come back to the queue.
Yeah.
Thank you. We have the next question from the line of Sandeep Dixit from Arjav Partners. Please go ahead.
Thank you for taking my call. Just wanted to understand a little bit on the MCV business. What's the total capital we have deployed in it so far, and what is the break-even for it? And also, what is the asset turn likely?
We've invested 28 crores in that business. It's from Sterling has invested 28 crores in that business. On a break-even level, like you see, at 120 crores, we're already making money.
Yeah.
So I think we don't look at break-even level. We are still in the growth phase, customer acquisition phase. There's a lot of investment going into tech, into people, into systems, etc., etc. I think it's early days to talk about break-evens. I think we are more interested to grow the business, acquire customers, and strengthen our technology base. I think that's our vision for now. In terms of cost optimization, we always have an eye on that, but that's not our primary focus. Primary focus is we want to do customer acquisition and customer servicing and tech building.
Right. And the asset turn? What are your sort of stable or steady state asset turn likely on this?
So I don't have the exact number with me right now. We'll come back to you on that.
Okay. The other question I had was just for a broader understanding. On the four-wheeler side, the government seems to be making a much more concentrated push for hydrogen fuel cells rather than the batteries, lithium-ion or whatever.
You're getting muffled. If you want to speak into your microphone again, please.
Yeah. Can you hear me now? Is it any better?
Better.
Yes. Okay. So I said that the government seems to be pushing the hydrogen technology rather than the conventional lithium-ion or whatever battery technology. How does that impact us in the MCV business, especially where the CVs and four-wheelers are concerned? If you can give me a broad understanding of how I should look at it.
So, the government is pushing. If you see the major application of hydrogen business is going to be in commercial vehicles, public transport. The hydrogen as a fuel for two-wheelers is not going to be very, very dramatic. So the applicability is very low in that. There's a lot of issues of engineering and supply chain and safety in that. So firstly, it's for commercial vehicles, etc. So currently, what the MCU business we are doing is substantially in the two-wheeler, three-wheeler space. Just to answer that. But yes, if we talk about commercial vehicles, etc., if the industry follows the hydrogen route, then products like motor control units and all definitely get impacted, including motors itself, because the powertrain changes substantially by using hydrogen as a fuel. So we don't, for our MCU business in the segment we are in, we don't see that as a threat at all right now. And having said that, on speaking about hydrogen, we are currently exploring opportunities in the hydrogen space also. As and when we have done some homework and analysis on that, we'll come back to you as to what our strategy on that is.
Thank you.
Can I just add to that, if I may?
Yeah.
So, I mean, I think Atul alluded to this a little bit, that if you look at the strategy for Sterling, we are very clear. We are in, we see ourselves, we want to stick to our core. Our core is the auto components business. The future of the auto components business is green fuels, and that's where we are heading. Whether it's whatever the source of energy is, whether it's lithium ion or maybe it's a metal air, or whether it's hydrogen, we are looking at all of those opportunities and trying to understand how we can play and provide value to our customers. So that's, I think, at a strategy level is what I would just like to reinforce what Atul had said. If you talk specifically about hydrogen, there are two aspects of hydrogen. One is when there's a play to use hydrogen in internal combustion engine. Now, this is similar to using CNG that you see today, right? Now, obviously, when you do that, then there are no motor control units or electric motors or anything else, and therefore that is a different segment. The second is when there is a fuel cell, and the fuel cell provides electric power, which is then used by an MCU and an electric motor. So, we need to kind of be very clear about what segments we're talking about. If it is a fuel cell-based electric vehicle, but it's an electric vehicle, then obviously MCUs and electric motors and such things will be there and will apply. If it is a hydrogen, if it's an internal combustion engine that is running on hydrogen, then that's actually a replacement for, I won't call it a replacement because they may coexist, but that's in the same domain as CNG is today. And there you won't have the electrification. So, I mean, if you look at the overall growth of electrification, hydrogen does not change that dramatically, because that's the segment that that I was trying to explain to you, the conversion of the use of hydrogen gas to power an internal combustion engine. That's a very small piece of that, and electrification as a whole, the numbers that we talked about, which we talked about in the beginning of the call, that 70,000 crores is the potential market just for two-wheelers by 2030 at 30% penetration. Those kind of numbers don't change, and then you add to that the three-wheelers and the LCVs and the HCVs and so on. So I hope that answers provides more detail to our response there.
Yes. Thank you very much.
Thank you. We have the next question on the line of Vinayak Mohta from Stallion Asset. Please go ahead.
Hi, am I audible?
Yes, you are.
Yeah. Hi, good morning. Congrats on a decent set of numbers. I wanted to start by asking, what is the kind of growth that we can look at going forward? Because I can see, given the expansion and the kind of scale up you're having on the EV segment, a 25-30% kind of growth is something that we can expect for the next 2 to 3 years.
I would say so. Yeah, I think that's a number we are also looking and beyond. Yes, you can. That's our expectation from the kind of trajectory we have built for ourselves in terms of customer acquisition, products, and capacity. So yes, you can look at that.
Understood. And what would be our utilization as of now on the EV capacity, on the 3 lakh capacity basically?
I think we currently are about, to my sense, on a 3 lakh capacity basis, we are at about 65-70% levels. And we have an expansion plan in place to take it up to 5 lakhs, which will be ready by June, July. Let me just add, to that. I think you got to look at the EV businesses from a different lens. Capacity expansions are not that dramatic in terms of financial needs or timelines. They're more tech-oriented. They're more about securing supply chains. Those are as critical parameters and just as laying fixed assets on the ground. So we are looking at being, by June, July, being ready with 500,000. And if there's a market uptick, like Jaideep said, we are also currently considering studying the potential of doing another facility in our tech center. And the lead time for that is anywhere from 6 to 10 months to do that.
Understood. And how do you see your working capital days evolving going forward, because they have increased substantially in the last 2 years? So do you think it will fall back to the 50-60 days range, or you'll see it remain elevated given the new segment and the customer orders all flowing through?
So I think you got to again separate the fastener business and the MCU business. Fastener business, I think the current cycle time we have will probably get more efficient by about 10 to 15 days going forward, because we were carrying higher inventory levels, keeping in mind the volatility in the steel industry. But I think that's becoming more stable, so we probably rationalize those the number of days down by 10, 15. In our motor control unit business, it's heavily semiconductor based. There's a lot of shortage, so we have commitments out. We have understanding commitments going up to 6 months' time on certain products of semiconductors. But currently we are, despite all those commitments, our current supply chains are very tight. The number of days you see are very low right now. We feel that if the way we are growing and we want to grow, we'll have to take a more aggressive or increase the number of days of working capital or inventory we carry to meet our targets going forward.
So is it fair to assume that post this quarter, you'll be basically given, your growth has continued. So post this quarter, is it fair to assume that you will see margin expansion, your working capital days going lower, which eventually will aid to the ROCs, and which additional capacities coming in, that would further aid to your growth level? So ultimately, basically, it's an improving trajectory on all the fronts from this quarter onwards? Or do you think that there will be certain amount of margin pressure because of the new capacity coming in, and it would take a half a year or so more for things to normalize and then move forward?
So I think working capital will not put much pressure on our margin structures at all. Our current finance cost is very minimal anyways. We don't see working capital putting much pressure on our margin structures at all. Yes, maybe there's a certain amount of capex going to the MCU business, but that capex is not very high. Maybe within a quarter or two, we'll be able to normalize those numbers. So I don't think you should worry about working capital putting any pressure on margin structures.
Understood. And one last question: any idea on the competitive scenario, and what kind of risks do you see the business to the business from a competitive scenario, or any other front that you guys discuss a lot within yourselves as a team?
So, do you want to specify what business are we talking about?
Both the businesses, but a little more focus on the EV segment, because I think that would ideally be the growth driver here.
Yeah. So our like we said in the beginning, our current market share is of 50% of high-speed scooter segment. Going forward, the penetration for these vehicles is going to go up dramatically. I don't think we'll be able to retain the 50% market share. Like I said, the potential size of market on 100% conversion to electric is about 12,000 crores roughly on a current level of 15 million two-wheeler units. It's just an Excel sensitivity you need to do. But I personally believe on optimal basis in the next 3 years, our market share may be in the range of 20%. So keeping in mind all the customers getting active, all the customer acquisitions we have done, and all the customers we have in the pipeline. So that's the kind of number we have set for ourselves for market share.
Yes. Thank you so much. Thank you so much.
Yeah,
and all
I'd like to make one. I was saying. So sorry, I want to make an apology to the group. I just said a number of 70,000 crores. Sorry, that should be 7,000 crores. That should have been 7,000 crores. So that was a number which I had, which we use for the two-wheeler market, which is based on 30% penetration and assuming an overall size of 30 million. So, I mean, because Atul was talking about current size, which is 15, we are talking about 20. What I mentioned was 2030, with a projection of about 30 million and 30% penetration will give you an MCU size only for that segment, MCU market size only for that segment of 7,000 crores. And then, of course, you add to that the three-wheelers and the, LCVs and passenger vehicles and everything else. The other question, I'll just like to, Atul had addressed this, but I'll just like to just give you a little bit more operating detail on this, that the numbers that we are talking about on capacity are not based on three-shift working. So even now we are flexing constantly because, customers in this segment have varying needs. We are able to add shifts. We are able to debottleneck, as I mentioned, and we are able to exceed because, just to give you quick numbers, 3 lakh pieces means 25,000 a month. That's something we can exceed in the month of February if the customers wanted it, because we have the ability to do so. So, just want to give you a little bit of operating flavor on that, because it's not it's not three shifts, 100% working. That's not how this number has been calculated. So, thank you.
Thank you. We have the next question on the line of Jayesh Gandhi from Harshad Gandhi Securities. Please go ahead.
Hello, am I audible?
Yes, we can hear you.
So a couple of questions from me. So from the earlier caller, can you just help me out in more understanding about the competitive landscape? I mean, who else are there other than us who are supplying MCU? And one question is regarding, see, if MCU is like 10% of the cost of electric two-wheeler, is there a possibility that OEMs go ahead and manufacture it on their own?
So the ones of the major companies that are currently selling, you really have only Mahle and Hella currently, and Bosch, which are currently selling any volumes. That's those are the people who take who are making up the balance 50% market share that we were talking about. Many other companies are talking about entering this space. What we have to keep in mind is that launching a product or introducing a product is very different from industrializing a product. Having the supply chain in place, securing electronic components, etc. So, there's a lot of talk and a lot of newspaper articles that come out. Sorry.
I think we need to give them a flavor of what does an MCU mean. An MCU is a hardware design, hardware supply chain, and there's a huge software layer on top, which is customized for each customer. And I think it's important for the investors to realize it's not purely a hardware product. You put together electronics and put a box together and give a customer. There's a huge software customization which happens, which is a differentiator in the product line itself. So it's not as simple as doing industrializing a hardware and shipping it out. There's a lot of tech work which has to be done on software on top. Even in the hardware, there's a lot of design capability which goes into semiconductor design, etc. So it's not as simple as doing a traditional auto comp. These are, for lack of a better word, there's a huge amount of technology which goes into it, which is dynamic on a daily basis, depending on the feedback you get from the customer for user experience, customer experience, interfaces which keep on changing. Each vehicle has a different user experience, and that user experience is being upgraded by the customers, by the OEMs for their customers on a regular basis. So it's an ongoing work on technology. It's not a standalone one-time product. It's a very dynamic work you got to keep on doing with existing product lines also with the customer. I think it's important to recognize that it's not a pure traditional hardware auto comp.
And I think to just add to what Atul just said, that it's what that means, what that software component means, because the MCU talks to the battery management system, talks to the vehicle control unit, talks to the instrument cluster, etc. So all.
Ladies and gentlemen, we have the line from Mr. Wadhwa disconnected. Please stay connected as we
While Jerry logs in again, let me just add to what is being said. So your second question was the OEMs themselves wanting to do it. Yes, that's always a threat for anything. Like the OEMs could have been tire manufacturers also, or could have been battery manufacturers in traditional space. But I think whether the OEMs can add the nimbleness and the flexibility and the speed with the way that the tier one customer vendors would. This is a huge software play in that. Whether their in-house tech teams can do that or not, whether they have that, like I said, nimbleness and the flexibility to do that. Even if, but if you look at from a more mature basis, industry matures over time. Even if the OEMs bring some components in-house, there'll always be a dual sourcing philosophy going forward because. Like I said, this is a customer user experience product, and doing everything in-house is always difficult for this. And I think that if you look at the experiences of other OEM companies in India and overseas, in India could be Mahindra Electric, and overseas could be Tesla, etc. They all have vendor partners for tech products. Mahindra Electric started with the philosophy of making everything in-house, and they realized that it is not possible to do that because the kind of engineering capability, flexibility, and nimbleness you need to do is not available with the large corporates because of their own structures. And I think so. Yes, that threat is always there, like competition. But idea is to stay on top of the game through your technology, through your design, through your quality levels and supply chain robustness to counter that. As long as you are able to do that and offer a good product at a very competitive price, I think there's always, it'll be very hard for OEMs to ignore that.
Okay, so that satisfies me.
And the second question, sorry. I think there was a second question. Sorry, go ahead, please.
Please go ahead, sir. Sorry.
What I was saying was the second question was, what is the value of the MCU? The value of the MCU can vary, like I said, from 3,000 rupees to a couple of lakh of rupees. And depending on the value of the, and you also have to keep in mind.
Sorry to interrupt. That was not the question, actually.
Okay, sorry, go ahead.
Okay.
Yeah.
The other question I've already addressed in terms of OEM competition coming in.
Okay.
The second question is around the warranty, that we put it into contingent liability. How do we calculate those contingent liabilities? I mean, is it on X percentage of sales that we put as contingent liability, or how do we calculate it?
Currently, we are on percentage of sales. We have taken, like I said earlier, we are looking at a very conservative number. When I say conservative, it's not a small number. We are taking a number beyond our own estimations because we are still 12 months into the business, and I think our view is we don't have enough data to say what may be the relevant number right now. But based on our current estimations, the provisions we have done are higher than that. But as a business, as we age with this business, as in when we have more and more units out in the market and we get some data back from that, that will help us crystallize what the relevant numbers may be. But let me assure you, the current provisions we have are more than what our current estimates tell us.
Okay. One last question is, we talked about moving towards 14-15% EBITDA margin even in our MCU business. What kind of
let me correct you. We never said that. We said it will be in the range of 8 to 12%.
Okay. I'm sorry for that. What can be the sales what should be the sales to move to that kind of level?
I can't. Can you repeat that question clearly? You're muffled.
What I'm trying to say is, while we are thinking of moving towards 8 to 12% of EBITDA margin in our MCU business, what kind of sales do you think should bring us to those levels?
I think we'll probably get there in the next year or so. I think anywhere from 400 to 600 crores will be at that level.
That's all from my side, sir. Thank you very much, and that's the
Thank you.
Thank you. We have the next question from the line of Arjun Gadam, an individual investor. Please go ahead.
Yeah, thanks for the opportunity. You have around 6% EBITDA margin is what you claim this quarter for the MCU segment. Is this after any contribution being made to your Chinese partner Gatex, or is it without that?
No.
This is net. I mean, this is after all expenses, all fees, all payments, everything.
Okay, so this is so what is the kind? So do you pay a royalty to the Gatex? What is the kind of and what is the nature of how we need to see this? Like you claim that you're going to have a 8 to 12% EBITDA margin going forward. So will this even consist of the royalty which you pay, or if you're paying any royalty, or what kind of?
Obviously, if we are looking at any royalties that are paid are a part of normal operating costs, in our opinion, and are not below the line. So any what we believe is a sustainable EBITDA is a sustainable EBITDA after all payments to our partners for the technology as well as for the other support that they provide us.
So the EBITDA margin, what you have this quarter, is after making the royalty payment to Gatex.
After all costs, totally, yes.
That it also includes the royalty, right? Because you don't have a joint venture with them. Just trying to get more clarity.
Yeah. We don't have a joint venture. It's a technical arrangement only. And so like Jaideep said, it's after all costs, including all fees and payments.
Yeah. Okay. That's it from me. Thank you so much.
Thank you. We have the next question on the line of Sumit from Finacle Investment Advisors. Please go ahead.
Hello.
Yes,
we can hear you.
Can you please share which part of the MCU we source localized or which we have to export?
Which we have to import, you mean? So very simply, all electronic components, active and passive, have to be imported because they're not available in India. All mechanical components, but the actual assembly of the PCB is done in India. All mechanical components are localized.
Can you give the details of what include in mechanical or electronic components?
Very simply, electronic components is ICs, MOSFETs, etc. And mechanical is all housings, all heat sinks, rubber parts, plastic parts, hardware. All of that. Terminals, connectors, all of that.
Okay. Can you please share who are the major supplier, customer, in India?
I don't think. I'm sorry. That's
confidential.
Suppliers. I don't think that's the appropriate question. That's company confidential data.
Okay.
We buy from the best. Our partners in this are the best tier 1 companies in India, not only in North India, but we have suppliers across the country who support us in our product in the manufacturing of our product.
Okay. How much amount of capital expenditure is required for building 5 lakh units?
We have right now we got a capex plan of 12 crores for this fiscal year, and next year we're looking at about 20 crores.
12 crore only for MCU business? Yes. Okay. And confirmation for the market size of MCU is 7,000 crores.
So I think what I had said was.
Jaideep, let me take that. The market size. Market size, Sumit, am I right? I'm talking to Sumit, right?
Yes.
Yeah.
So market size, I'm giving you the broad numbers, then you can calculate the market size thereon from yourself based on your own assumptions you want to carry. Like I said, the current two-wheeler market is 15 million, expected to grow at whatever clip you want to project at. The current size in 23 is 15 million, expected to go to maybe 20 million in the next 3 years. Whatever penetration you want to take as a percentage of that, the market is saying 50% penetration in the next 3 to 5 years. If that is true, you're looking at a 10 million unit two-wheeler market size, and that's only two-wheelers. Then you got three-wheelers on top, passenger vehicles, commercial vehicles, etc. on top of that. So just give you a flavor of the market size. At 10 million unit level, an average price of 8,000 rupees, the market size is 8,000 crores on a 50% market share for EVs. So the rest, 8,000 is the minimum market size. It could go up to, like I said, 16,000 crores also, depending on the penetration we have. And that's only in the two-wheeler segment. And you got another 500,000 three-wheelers, which are at a higher ticket price. Then you got commercial vehicles, you got passenger vehicles. So the market size is extrapolation on that. There's a lot of data out there in the field. There's a lot of reports circulating, which I'm sure you have access to, which will give you a total size of the market.
Okay. Thank you. That's all from my side.
Thank you.
Thank you. We have the next question from the line of Nidhi Barbria from Envision Capital. Please go ahead.
Thank you for taking my question again. Sir, if you can just help me understand how do we pass on the steel prices, and what gives us the confidence that our EBITDA margin for fastener division can go up as high as 17 to 18% in near term?
So Nidhi, couple of things. Historically, we have operated in the range of 16 to 19%. That gives us one benchmark we like to work with. We, based on our quality, cost, delivery service, etc., and our customer confidence, our product range we do with different customers, the critical quality of components we do with them, we believe that's a second factor which we believe we'll get to that again. Finally, on the steel part of it, it's a negotiation exercise with customers, and based on the history of the last 30 years, we believe that whenever the steel has gone up, we've been able to negotiate compensation with our customers on that, and we've been able to get full compensation to address those cost increases. So I think based on the history and on what we have done, we believe we'll be able to get back to that again, and which we have shown. It's gone up from 15 to 16%. And the balance impact is, like I said, a numerator-denominator effect. So as and when the time passes, all this will balance out. We are reasonably confident that we'll be able to hit those numbers again very soon.
Okay, so only if the steel prices are increasing from here, let's say by 20% or so, I'm just giving a very rough number, then that would be the only area where we won't be able to maintain our guidance of 17 to 18% kind of EBITDA margin in next year.
No, I didn't get that question. Can you repeat that question again, please?
So only if the steel prices are moving abruptly in the near term, that would be the only area where we won't be able to maintain the 17-18% kind of EBITDA margin in FY24-25.
No, firstly, even if the steel prices go up, on a worst case scenario, I think steel, my sense is probably peaked out. There'll be marginal movements of steel upwards or downwards. But even if the steel on a worst case scenario goes up by 20%, we are reasonably confident that we'll still be able to move the needle positively on our EBITDA margins.
Okay.
Because we get full compensation from our customers.
Okay. And sir, on this GTEC JV side, currently we have done some 120 crore of revenues in 9 months. What type of revenue sharing are we planning to do with these JV partners for current year, till the time we are not getting the approvals?
Firstly, they are not JV partners. Their initial plan was to be a JV partner because of FDI regulations which kicked in a couple of years ago. This enterprise could not be a joint venture. Currently, it's 100% owned by Sterling Tools, and that's the way it's going to be. So the relationship has morphed into a technology agreement with them. So there's no revenue sharing happening with them.
So then what do they get from sharing the technology?
So I think they're a large part of our supply chain. A lot of the electronics, a lot of the softwares are coming from them, and I think so we have a combination of that supply chain, and also eventually there's a certain amount of technology fees / royalty fees we are working with them on.
Okay, so the royalty fees and all those components.
This is the operator here. Ms. Nidhi, we request to kindly come back in queue for follow-up questions.
Just this last question, please. So, sir, till the time we are finalizing the royalty payment and all those things, what are we going to, how are we going to share the things in this current year?
So, like I said, there's a lot of supply chain activity which is happening jointly with them, and this is being addressed through that.
Okay. Okay, and just one last thing. Our total capex for FY23-24, which we said that it will be 12 crore and 20 crore for MCU division, what would be the other divisions capex, like the consolidated capex for 24?
So the capex for the fastener business will be in the range of about 25 odd crores.
So 25 plus 20 crore for MCU, which is 45 crores.
Correct.
Okay. Okay, I'll just come back in soon.
Thank you. We have the next question from the line of Tushar Sarda from Athena Investments. Please go ahead.
Yeah, thank you for the opportunity. I have just one follow-up. You mentioned that you do this product MCU for three-wheelers also, but when I look at your chart on page 23, the three-wheeler is only 1% of the segment mix. So what is the reason for this? Because I thought EV traction in three-wheelers is very high right now.
Jaideep?
Yeah, so I think there are a couple of reasons for that. One is that some of the programs, as I mentioned, some of the programs have been delayed because of the new battery regulations that came in. Secondly, we do sell some, we do sell some of our MCUs through partners. And when we get to a three-wheeler, people use a motor control unit, and an e-axle. Now we do sell which is an axle, which is together. This is called an e-axle. Now what happens is that some of our sales are to companies that integrate units into an e-axle. We show that because we don't know, they can use that for a two-wheeler product or they can use that for an e-axle, because we just sell it to an integrator who then supplies the electronic powertrain or the electric powertrain to an end customer. So we don't know what the end use is, and therefore, maybe some of the numbers are getting lost in there. I will work with Pankaj and try and get greater clarity on that for our next quarter results, and try and ask our sales team to give us a little bit more clarity on the actual end use, so that we can clean that data up for you a little bit.
Thank you. And Pankaj, I have one suggestion. I don't know if you'll be able to do it. You report the standalone and consolidated. So if I want the EV business, I actually have to, put it in Excel and do consolidated minus standalone. If you can report P&L separately for EV, it will just become easier for everybody, because I think there is a lot of interest on EV business right now.
We'll come back to you with that.
It's new.
We'll come back to you on that.
We'll revert back on this.
Yeah, thank you. Thank you.
Thank you. We have the next question from the line of Nikhil from SIMPL. Please go ahead.
Yeah, hi. Thanks for the opportunity. Just one question on the MCU side. As you said, there is a combination of electronic components and mechanical components.
That's
now,
right.
When we look at the electronic components, a lot of these chipsets and everything had seen a heavy price increase in last year, and now
Yes.
things are coming back. So how does the pricing happen for the product? So because when we would have taken the orders, we would have taken the base pricing of last year, but now when we are giving the orders to the customer, the prices have gone down. So the price variation on the component side, is it borne by the customer, or
So,
is it like, yeah.
So I don't know where you're seeing the pricing going down. We haven't seen that as much. You know, when you talk of chipsets, let's talk about just controllers. Different, you know, you have different makes of controllers. Do you have different end users of controllers? I'm just talking not controllers to use DSP, other that confuse you. So the microprocessors have different makes and different end users. For the electric vehicle and in these areas, there is absolutely no let up in supply issues. And therefore pricing is still a concern. And I think one of your colleagues had asked earlier about margins, and I had explained that as things stabilize and, you know, ease out a little bit, we do hope to be able to get you know, better margins by negotiating better with the end suppliers. Now, in terms of, you know, what happens with the customers, we do, you know, we can work with customers on pricing. We can go back to them and say, listen, here are the supplies that have happened. Here is, you know, sorry, not here are the supplies. Here is what we use, and this is what the price increase is. And we can request them for price increases, or they can come back to us for price reductions. But the market today has really, we've not been focusing on that. All we've been focusing on is supply, because it's been a desperate struggle to secure DSPs and to actually push out the volumes that we wanted to push out. So neither our customers nor we have, you know, tried to, you know, focus too much on if there's been a variation. But in the future, as the industry stabilizes, definitely there will be price adjustments basis movements on electronic component pricing.
Okay, so would it be right to say that as of now we are bearing that higher cost, and we are
that's what I had said earlier.
Okay.
I tell you that to be able to meet the, I mean, please look at the ramp up that we have done. You know, from a pretty much a standing start, we are doing more than 20,000 units a month. That's a.
No, I appreciate it. I'm just trying to understand, because then the base profitability is not.
What I'm saying is, not only have our suppliers increased prices on us, we've also had situations where we've gone out and bought material in the spot market and paid double and triple just to be able to meet supplies. So it's not only about you know, a TI or an Infineon saying there's a 20% price increase. If they don't give material, we still have to keep the customers' lines running.
Correct. No, I appreciate it, and really appreciate the way the company has scaled up. So really congrats on great achievement. Just one last question, sir, on GTEC. When you said that we are working with them on the royalty arrangement, or what kind of an arrangement, so just one clarity, it won't be retrospective because we've been doing sales.
No, not at all.
Oh, okay.
And that's, I think, another colleague of yours had asked that question, and we had clarified that all our numbers as we report them are after all expenses. We, you know, because we've had to constantly adapt in our relationships, so it's difficult to give you a specific thing. But at any stage, whatever we report is after all expenses. We have no further liabilities or claims from GTEC on any account.
Okay, and last on this contingent liability on the export side, which we had in our which we report in our balance sheet. So is it a large material number which is left, or?
I'm glad you raised this. I was going to take it in the closing comments. So the contingent liability, firstly, you see is the large number is for an export obligation number. That's the revenue we need to do from export proceeds in terms of selling prices. But in case there's a default on some values on that, the liabilities are a fraction of that amount in terms of a few crores of rupees itself. So it's not the numbers when you read the annual report, they seem very large, but the potential liabilities in terms of penalties and interest are much lower. Now, having said that, We are currently in the process of realigning all these numbers of EPCG obligations. We are working with the relevant government authorities, keeping in mind the momentum on exports, etc. And we hope to bring down this export obligations by a substantial amount within this financial year, working with it, like I said, with the relevant government authorities and working out the potential liabilities we need to pay, and keeping in mind also the future export potential we have. So you'll see a lot of clarity coming in the final year call, full year call. But I just want to repeat, this is being addressed very closely, and and the number is not, for a lack of a better word, the potential penalty number is not very material. So I would not worry about it, but I just want to address the flag since you're raising one. I was going to take it up in my closing comments anyways.
Sure, sir. Congrats and best of luck for the rest of the year.
Thank you.
Thank you.
Thank you. We have the next question on the line of Rahil Shah, an individual investor. Please go ahead. Mr. Shah, can you hear us?
Hello, hi. Yeah, I think my question is.
I can't hear you.
Mr. Shah, we can't hear you in the call. I believe Mr. Shah has left the queue. I would now like to hand it over to Mr. Atul Agarwal for closing comments. Please go ahead, sir.
Yeah. Well, thank you very much, everybody, for spending time with us this morning. I just want to repeat a couple of things which I was hoping to do in my closing comments, but as a question came up on EPCG obligations, I want to reassure all the investors that this is being addressed. It's more of an optical issue, but we are still addressing it. The penalty numbers are not material. But having said that, we will address the numbers. You'll see we are currently in negotiation with the relevant government authorities to do that. We'll give you more clarity in our full year investor call. But just to reassure you, this is being addressed, and the numbers are not very material either. We have a lot of momentum in our legacy fastener business. We are up 33% in revenue 9 months, and we see last quarter is looking quite good as well. And even the next year, when I see the next year, there's a lot of momentum in a lot of the segments, and probably also because FY24 is going to be more like an election year with elections coming up in May of 24. We see that there's going to be a lot of spending across segments coming through. So there is momentum of growth in our fastener business as well. Also, going to our putting aside the fastener business on one side, our vision, like we've been saying in the last 3 years, has been to invest more and more into new technologies. We started working on electric vehicle components 3-4 years ago, and we were able to identify our motor control unit business, which on a full year, we'll have the first full year of operations this year. And as you can see from the numbers, there's a lot of growth in that business this year and a year forward in terms of customer acquisition, product pricing, margin structures, supply chain enhancements, localization, and most importantly, the tech capabilities we have built in our facilities, the capacities we have built. That's giving us a lot of first mover advantage vis-a-vis our competition, and we hope to continue investing to maintain that particular growth trajectory and also address the market going forward. Also, we are currently assessing a few more product lines, could be onboard chargers or other green technology systems. It's early to talk about on this call right now. There's a lot of homework going on that. But let me show you that we are working on some exciting stuff going forward. And as in we have some more clarity on some of those products and product lines, we'll keep you informed. But our vision going forward is going to be a lot more Because of our success in our motor control unit business, our vision going forward is going to be more on electronics, green tech, and new technologies in the business line. So net, we have a lot of momentum. Vision is very clear, and you'll find us coming up with promising results and a promising future. Thank you.
Thank you. On behalf of Sterling Tools Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.
Thank you.
Thank you.